hope you're having a great summer. I am taking a couple personal weeks at the end of August, and I am reading for you some of the articles that I've written. I don't know if you know this, but I've written quite a bit about tax and financial issues for small businesses. And so I've been reading some of these into the podcast so that they're accessible to you in audible format. And I wanted to talk to you today about one of the most frequent issues that comes up in my one-on-one sessions with clients, which is over the issue of how to track your finances and what you need to do in terms of forming an LLC. So I get so many questions about LLCs because they're very confusing. LLCs are legal entities, but they are not tax entities. So they don't actually change anything about your tax situation. And that is very confusing, understandably. But there are some things that LLCs do for you that are wonderful. And people don't realize a lot of the times what the obligation side of that is. What do you have to do to maintain your LLC? And what do you need to make sure you don't do that could invalidate it? So today I'm going to talk to you about business and personal accounts, keeping them separated, and how that dovetails into the issue of your brand new LLC. All right. So I hope you enjoy this piece of writing I did and updated very recently. Enjoy. Also, I want to give credit to Patty Johnson of Art F City, where this article first appeared a couple years ago. Patty Johnson, if you don't know her, she's an OG of the art world. She had the first ever, I believe, art blog, Art F City. And I was a columnist there for several years. And Patty taught me so much, frankly, about being a great writer. So I owe a lot to Patty. I will link to Patty and her program. She now has a company called Workshop, and she runs a program called Network, which teaches mid-career artists how to get more shows and more visibility. So I'll link to Patty. And here's my article, Business and Personal Accounts, Keep them separated. There are a million meaningful reasons to operate an arts business, from creating revelatory art experiences for the public, to a commitment to a tradition, to the love of making handcrafted objects. But at the end of the day, if it is a business and not, say, a nonprofit, a major purpose is to make money to pay for the expenses of living. And if the purpose of the business's earnings is to pay for our personal expenses, why then is it so important to keep the business financial transactions separate from our personal ones? The reasons are simple. It protects you from tax trouble and legal trouble, and it's the law. Here's an example to illustrate the tax trouble scenario. Let's say you operate a letterpress. Your core income is from printing high-end wedding invitations, but your true love is printing full-color publicity posters for rock bands. This is a totally respectable business model, and while you love what you do, you are definitely earning a living. But the business part has never been your strong suit, and you've been depositing your printing business money into your personal checking account and using that same account for personal expenses like buying groceries and clothes and paying rent. Now, let's say that after a string of bad years in your printing business due to forces beyond your control, a boycott of your state because of a recently passed piece of transphobic legislation, for example, you get audited. So far, this is all pretty normal. People with a string of losses in their arts business, or any business, will tend to get targeted for audit because the IRS wants to check that the business is legitimate and not a hobby or a tax shelter. Because your printing business is generally sound and the recent downturn is explainable and not within your control, you can probably expect to come out of this audit unscathed. But when the IRS looks at your bank records, they see one account where business and personal items mix together. To them, this is a strong indication that your business is a personal hobby and not something you take seriously or treat in a business-like manner. They deem it a hobby and disallow your recent losses, resulting in you having to pay back the difference in taxes, plus penalties and interest. It totally sucks to be in this boat, and you could likely have avoided it if you had a separate business bank account and you kept it clean of personal expenses. The IRS, for the record, has a 9-point list, and I'll link to that in the show notes today, of factors they consider when judging your arts business is a bona fide business or a hobby. And they give a lot of weight to the separation of your business and personal accounts. Here's an even more serious example of how mixing your business and personal expenses can hurt you. But first, a little background on corporate entities. Businesses are run by individuals. When you operate a sole proprietorship and file a Schedule C for it on your personal income tax return, you have no legal separation between yourself and your business. Millions of small businesses in the US operate this way. And when you're small and not accruing much liability, it's perfectly fine to do so. But a snag arises when you get in legal trouble. Let's say that you, Artie McArtist, are operating a sole proprietorship arts business. You make large wooden sculptures, and during your latest installation, one of the installers is crushed when your sculpture falls on top of him, and he can never work again. The worker decides to sue. Because there is no legal separation between you, Artie McArtist, the person, and Artie McArtist, the business, when he sues you, he can not only go after the assets of your business, your tools, your studio, your inventory, he can also go after your personal assets, your home, your car, your kids' college fund. Ouch. There is a way to eliminate the personal legal exposure that this nightmare scenario illustrates. You can make your business its own separate legal entity by forming a limited liability corporation, or LLC. The main point of becoming an LLC for most small businesses is to protect their personal assets from a lawsuit. This separation between the individual and the business is referred to in law, and rather poetically at that, as the corporate veil. However, as an accountant, I want to warn you against the mistake that people make here. When you form an LLC, it becomes critically important that the business entity really is separate from the person running the business. The corporate veil must be real. Among other things, this means you must track your business books and keep a separate business bank account. If you go to the trouble and expense of forming an LLC, you are agreeing to maintain that separation. So what happens if you don't? If you don't bother maintaining separate bank accounts, or if you make frequent personal purchases out of your corporate account and you use the company car or the corporate jet for all kinds of personal errands, and then you get sued, the court can pierce the corporate veil, and that's what it's called. In other words, in a lawsuit, your business practices will come under scrutiny. And if you're found to be acting as one and the same as your business, not as a separate, distinct entity, then that legal protection you thought you had drops away. And the plaintiff can come after your retirement fund, your house, your art collection, and your vacation fund. So now that I've scared you, what can you do to prevent these awful scenarios from happening? Primarily, you want to operate in a business-like manner. You need to keep your business accounts and personal accounts totally separate. If there are any credit cards that you use for both business and personal expenses, cut it out and get a corporate card for the business. A happy side effect of keeping your accounts separate is that your bookkeeping becomes a lot easier. When you have a separate business credit card and checking account and you use them strictly for business reasons, there is no more combing through bank statements to figure out which is business and what is personal. Your hardest problem is just figuring out what legitimate business expense category to put each purchase into. So if I'm earning money in my business and the point of having it is to make a living, how do I pay myself for my business account? Great question. You are allowed and even reasonably expected to move money in between your accounts. When you invest your personal money into your business, a common occurrence, it's called a capital contribution or an owner's investment. And that's the category you put it into in your books. When you take money out of your business to pay for your personal living expenses, it's called an owner's draw. And likewise, you record it as such in your books. The point? You track it in your bookkeeping. Note that you shouldn't be using the corporate card to charge a gorgeous leather jacket at Prada and then booking that transaction as owner's draw after the fact. Though this is the way to correct that mistake if you happen to make it. The best practice is to withdraw a chunk of money in predictable, periodic fashion, like you're paying yourself a salary. So the simple takeaway here is clear. Keep your business books clean and businesslike. Separate your personal and business bank accounts. It simplifies your bookkeeping. It's not hard to do, and the trouble it can keep you out of is worth all the effort. All right, that's my article. I hope you enjoyed it. If this was useful or helpful to you, or if you have a friend who it can help, would you share the episode with your friend? And if you liked it, feel free to leave a rating or a review. It really, really helps people discover this podcast. Thank you so much for listening. I hope you have a wonderful summer, and I will see you next week. Bye. Thank you for watching. If you like this video, be sure to like, leave a comment, and subscribe to my channel. I'm so grateful for that. This video is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links I reference at sunlighttax.com/podcast.